I'm Manveen Toohill. I'm the L&D manager here at the MGAA, and delighted to welcome you to our first session of 2026. Probably a little bit too late to say Happy New Year, but we'll say Happy New Year nonetheless. Just a few housekeeping points that I want to run through before we start. You'll see that your microphone and camera are turned off. We do ask that you keep this off just for the duration of the session, just so that we're not competing for bandwidth and minimises any interruptions during the session. We do ask that you don't use any AI notes for note taking. So we don't have permission to do that, but we do have a transcript option running in the background using Teams. We encourage you to ask questions, and they're more than welcome in these sessions. We will have the main presentation, then we will go to Q&A at the end. So please do feel free to save your questions, use the chat, and we'll allow you the option of asking your question verbally if you'd like to during the session. This is being recorded and a link will be shared to you after the session as well. So feel free to review or to access that as well. We'll also share a feedback survey link at the end and in the email. So please do take some time to complete the survey. It takes no longer than 2 minutes, but just allows us to keep delivering these fantastic sessions to you. And then one final point before we get things up and running. These briefing sessions are CII CPD accredited. So if you feel this session meets your training needs, you can utilise it on your CPD log. So that's all my housekeeping points done for today, or this session. It's great to hand you over to David and Henry from Guy Carpenter, who are going to deliver today's session. Over to you. Thank you.
Thank you. Thank you very much, everyone, for joining in. Firstly, I'll just apologise. I have a little bit of a cough lingering, so apologies on that front. So we'll just do a quick introduction to myself and Henry. My name is David Pedlow. I've been at Guy Carpenter for 12 years and came in via the JLT acquisition. I'm currently working and heading up our global specialty access business, and I'm also managing director within our global risk solutions unit within Guy Carpenter. And that unit, we'll touch upon the former a bit later, but the latter focuses on effectively utilising reinsurance for capital optimization. Chartered accountant by background, and I've also had roles in finance and strategy across the business.
Brilliant, thanks David. Similar to David, I came across to Guy Carpenter via the JLT reacquisition around 8 years ago now. 7 or 8 years ago. Predominantly, I sit within our cyber team, part of global specialties, focusing on MGAs, treaty, retrocession, and I also head up our kind of innovation and emerging risks unit. And predominantly, that is around placing MGAs in more kind of niche specialist lines of business. So it's fantastic to be here today, and we look forward to our session.
So today we're going to run sort of our 5 sections. We're going to give you a holistic overview of the 1/1 renewal. We're going to talk about some of the key factors and trends that led us to this stage. We'll give you a drop down into some of the classes and give you a little more specific in terms of how they reacted and the impact on rating and renewals overall. We'll give some thoughts, Henry and I were talking about potential implications for the MGA sector. And then we'll finish off just to articulate, as I said at the beginning, what our access unit actually is. And if we have time, we'll go into a Q&A. So 2025 renewal was effectively termed a good bad renewal in the press. 26 renewal from a reinsurer's perspective is gravitating towards the bad end. We entered into the 2026 renewal period of an extremely profitable year in 2025. We had the lowest reinsured loss for over 10 years, catastrophe loss, I should say. And we've had ILS finding new ways to access different types of risk in different structures, which again, we'll touch upon in due course. And really, when you look at it from a holistic view, we would term it as ultimately a buyer's market. Now, that is an important point to be very clear on the holistic side of it, because depending on the class of business, depending on the geography, depending on the loss history, there is slight nuances as we go through there, but we're sticking at the high level for the purposes of this slide. Rate was anticipated to decrease as we went into the renewal cycle, but I think what took everyone by surprise was the speed and quantum at which that rating reduction actually occurred. If we put it to sort of triangulate past points of reference, it's the biggest rate reduction we've had in over 12 years. And on a risk-adjusted pricing basis, we're back to 2022 levels. And what really sort of reaffirms that view is the investor community. The investor communities have effectively been risk off the reinsurance sector, and that has been reflected in their share price as they've seen significant reductions over the past week or so. However, what you do need to sort of weed out with some of the noise and what you may or may not have read in the press is a lot of those headline rate reductions are more remote layers, i.e. higher up the programs, which are less likely to trigger. And there is a feeling that the premium income to be generated by the overall reinsurance industry will not be as heavily as impacted as those headline numbers might suggest. And the fact that capital still enters the market and reinsurers are prepared to write business if they can get access to it does firmly indicate that pricing is still adequate, even though that we're seeing those reductions come through. So some of the headline numbers we've seen were up to a -20, and Henry will touch upon some of those lines. But really, all in all, if it was loss-free, bar US liability, which does remain a concern, you were starting to see rate reductions overall with your core renewal placement. Reinsurers had a sizable sign versus authorised lying imbalance. And to put that into context, we've done some analysis here within our property unit, and we reckon demand for limit was up 5 to 10%. That got fulfilled, and we still have circa 25% of excess capacity that needs to be utilised and or wants to be deployed going forward. Again, following off of that point, that it wasn't all bad news from the reinsurers. Retention levels broadly stood firm. 2023, which we'll touch upon a bit later, there was a significant re-underwriting of portfolios. Retention levels got pushed up quite substantially, and they're holding, which is a good outcome for the reinsurers overall. Part of that 2023 renewal also resulted in non-concurrent terms, and that was very fast across the board on program placements, and that was a result of just a general hard market, and that was required to get business placed. One of the key objectives that was asked for the broking community was to try and narrow those concurrent terms, and I think overall that was achieved with regards to most placements. One of the key features, and this is more when you're of scale and you're enterprise to enterprise level, casualty renewals were traded for access to property. And what that meant is if there was a difficult casualty placement, our cedents and clients were looking at it as an overall relationship going forward. And that's a flip on where previous cycles have been, where ultimately to get access to the casualty, you had to write the property. And finally, what we also seen coming into the market is new and innovative solutions. One of the key areas we'll touch upon is cyber, which Henry also will give a bit more of a deep dive into. But we've also seen ILS capacity looking to get closer to the insurance risk, and also diversifying into longer tail lines, where previously it had very much been focused on the short tail lines. So in summary, buyer's market, great for cedents, great for our clients. Reinsurers' impact of that renewal is not going to be as great as perceived and interpreted within the market. Keep an eye on some of the smaller players, because where they had sort of smaller follow lines, they may not have had those renewed. But on the upside is where rating was perceived to be inadequate by some of the other larger reinsurers, they may well have picked up lines. So that'd be an interesting area to look at. But really, all in all, I'd say the market is still in a state of equilibrium. And everyone continues, insurers, reinsurers, to make money, and the outlook is still positive for the sector, which will come on in a minute, but not obviously as strong as it has been over the past 3 years. Thank you. Slide. So what got us to this point? Look, we've got sort of 4 or 5 slides. I'm not going to spend too long on these. Because the reality is we're probably a little more concerned about looking forward into the future. 2025 was a strong year. Return on equity was 18%. That is the 3rd year in a row where return on equity has exceeded the cost of equity, i.e. the level at which investors expect. The drivers of that, I mean, the technical result, 2023 resulted in that ultimate portfolio re-underwrite, which pushed up the attachments as mentioned. Terms and conditions varied and narrowed in certain instances that I've discussed, and rating went up massively. So they're benefiting still to this day from that re-underwriting of that book. A very important point, an interesting point, is the share of catastrophe losses. 2025 was 120 billion catastrophe loss year. What's unique about that is that's down 18% on a 5-year inflation adjusted average. And that was set against which we had the largest Q1 catastrophe event in living memory with the California wildfires. The story could be a lot different. Again, we'll see this a bit later on if there had been an active wind season, but it was very benign wind season. So what you've had is you've had a benign year, catastrophe year, alongside the type of event driving those overall losses into the industry. 50% of that loss number is related to severe connective storms, and that has been a trend over the past couple of years. And a lot of those events lack the degree of severity where you're starting to trigger the overall reinsurance programs. And because you've had retentions pushed up, the type of event, that means it's not really triggering into the reinsurers' overall capital base. Thus, it is the lowest reinsured catastrophe year in circa 10 years. The investment environment, look, we all know about the geopolitical and economic issues out there. We've got persistent inflation, tightening monetary policy. And as a result of that, there is increased rating on bonds and or just overall interest rate environment being favourable. That means that the asset side of the reinsurer's balance sheet is benefiting greatly from that, and that investment income is an additional tailwind over and above the technical result as they go forward. Reserve adequacy, you may well have noted in the press, we've had US liability concerns on the accident years 14 to 19, and there's been a lot of strengthening that has occurred over the past couple of years. The reality is there's been enough additional redundancies in other lines of business to more than offset that. Although I would say that the degree of offset has been narrowing, and that is an area that we need to continue to watch. And again, as that's part of one of my other jobs is to look at that from the reinsurer's perspective and insurers. So all of those factors have meant retained earnings have gone up, and ultimately that has generated excess capital. That capital has a number of ways that it can be deployed. When you look at your overall capital strategy, you can look at M&A, which is becoming an increasing focus. We've just seen the potential Beazley Zurich thing, acquisition. Where was I going with that one? You can redeploy that to organically grow, or you can do share buybacks or dividends. And at the minute, the sector is very much focusing on the former two options. Move on, please. So the next slide is just going to illustrate and look at some of these things sort of in a historical way. I'll not dwell on these, as I said at the beginning, for too long. I think the key thing to focus here is really the orange components. What the blue charts show you is the catastrophe loss number each year, and the orange line tells you the percentage that is recovered via the reinsurance industry. And you can see that the past 3 years, 12% of those losses have found their way into the reinsurance market, where historically over the past prior 6 years, it's been running at 20%. So that just reaffirms that point around ultimately that catastrophe loss year being the lowest in 10 years. So this again it just shows you ultimately the yield that has been generated by the reinsurance industry. You can see it over the past at the far right. And some of these, obviously, we need to, they roll out to 2025, but the picture hasn't changed at the end of 2025. But 2025 and 2024 are the highest it has been since 2012. So again, that just shows you that ultimately you've had that increase in performance, lower cat events hitting your programs, and you're generating more on the assets. So look, I know there's a lot again going on this slide, but I think this is a great slide that we produced to show you the market cycles. And what you show here is you show major events, and you show the cycle, and you show ultimately how much return on equity the reinsurers are generating. So red is obviously where there is ultimately a dilution in value. Green, and that is ultimately a soft market from a reinsurer's perspective. The green is ultimately sort of the more harder market, so as and when the reinsurers are able to generate more than they're expecting. And really, if you go to the far right, you can see that massive spike between 2022 and 2023, where returns were below the cost of equity. and that sprung up as a result of that re-underwriting the portfolio. It is starting to taper off a bit, but again, that reaffirms and shows that the reinsurers are still making money, and still that money is more and above the cost of equity that the investor community is expecting. What's interesting is across that soft cycle, which is 2017 to 2022, where you had COVID, Ian, Jebi, Irma, and some of that casualty, loss creep, etc. There was an overall dilution in value and capital across the industry of around 22 billion. By the end of 2027, provided things and projections land where they are, that's going to generate an additional 75 billion of premium. So over that past period, it's more than offset that value dilution, created some value. There's an anticipation that additional 50 billion of that 75 will find its way back into the reinsurance sector as we continue to trade forward. So this again just shows you the trend of the actual capital that is aligned and facing off from the reinsurance sector. I'll start at ultimately 2021 to 2022. You had a decrease from the 571 to the 530 as a result of Ian. Then you had that re-underwriting and hardening that went on in 2023. So what you had was the overall capital facing the industry grew 7% in 23, 7% in 24, and it's expected to grow 9% in 2025, such that the industry has around circa 640 billion, 650 billion currently being utilised from the reinsurance sector. The split between the dark blue and the light blue just shows the traditional reinsurers and the ILS. And what is clear from that is everyone's growing, traditional and ILS. I think ILS is up 10% going from 24 into 2025. And that they're trying to find new ways, as I said at the very beginning, of accessing risk. And look, I'll just touch upon this briefly. This is the global insurance pricing, and it's produced by our sister company, Marsh. Now, there's a number of factors driving that, but what you can see is over the past 5 quarters, it has been decreasing. We're expecting a further decrease in Q4 once we manage to update this. And there is a degree where you can look at it from the tail wagging the dog, i.e. the reinsurance sector had increased but is softening. That softening is being reflected in the insurance pricing. Alongside that, you do have other factors. There's increased competition, and the MGA sector is coming into there and fighting for business. And insurers are also trying to continue to compete. And then they're still quite happy where ultimately inflation is being managed through the pricing. So again, that is just a key thing to point out around the tail wagging the dog and how that the reinsurance can impact the insurance industry, which then will ultimately impact the MGA's sector overall.
Brilliant, thanks, David. So I'm going to spend the next, kind of 10, 15 minutes just looking at an overview of some key classes that we also think are relevant for the MGA sector, and also what reinsurance renewals at 1/1 kind of means for the MGA sector kind of going forwards. So kind of similar to what David outlined previously, I think we can all see that supply across multiple lines, especially kind of property and specialty lines, the supply of risk capital was definitely up at 1/1. I think that abundance of capital does present attractive opportunities for MGAs, and we will come on to kind of why on another slide. But just looking at kind of property demand, so that's kind of the demand for limit was slightly up, but the supply was definitely up, as David mentioned. When you have a benign kind of cat year, there was definitely more supply. So that's meant that, especially per risk placements, experienced rate change of flat to -15, and and I've focused here Europe, but we also have figures on the US. The Europe property cat rate on land index decreased by 15%. Casualty demand and supply both fairly flat. It was a stable renewal, but US liability and kind of nuclear verdicts definitely remains a wider concern. Marine and energy, again, kind of flat-ish kind of demand. Supply slightly up, Non-loss impacted business was flat to minus 15%. Cyber demand slightly tapered on the proportional side, but definitely more demand for the non-proportional structures. Supply was definitely up. Ceding commissions on proportional was up by up to two points, and non-proportional rates, however, reduced up to minus 25%. Trade credit and political risk, there's probably more demand than there is supply. There's quite a lot of MGA interest to write trade credit and political risk, but at this stage, there's probably more demand to enter in this class than there is supply. However, on the reinsurance side, there is still pricing reductions of down 10 to 15%. So just a quick spotlight on cyber, which is predominantly kind of what I tend to look after. The cyber reinsurance market, has been very dynamic and ripe with opportunity. It's really important that the cyber reinsurance market kind of continues to grow, continues to innovate to meet what's going on in the underlying market. The underlying cyber market, obviously in 2022, there was huge rate increases. That has kind of come down in steps, and now we're kind of getting quarter by quarter, still kind of minus 5% rate reductions. But the underlying exposure of the cyber insurance market has grown. So actually putting in some of these new, more innovative kind of reinsurance structures will enable the next time the cyber market kind of does harden, that there is kind of these structures in place to enable people to kind of grow appropriately. As mentioned, supply is definitely up. Demand was definitely up on the non-proportional side. I think insurers have got more comfortable with attrition in the cyberspace. I think vendors and improved modelling views and understanding of PMLs has led to cedants certainly looking at ways that they can focus on taking the tail out rather than kind of protecting more kind of near-term volatility. So that's why sessions have reduced, and they focused on cat protection. So GC, we've been putting together innovative structures like our cat stop product, which is a combination of event and aggregate. We've also developed a brand new Cyber XXL product, which is the first time a kind of a dedicated hard retro product has been done on an underlying book of excess of loss. I would say that reinsurers definitely have improved their understanding of cyber. They ask for a lot more data because they themselves have engaged with models such as CyberCube, RMS, Science, etc. So there's definitely a lot of focus on data quality from cedants. And then finally, last year 2025 was not necessarily a benign year for cyber events. They might be more benign in terms of what the insured loss was compared to economic loss. We definitely saw large events around supply chain incidents. So there was the retail kind of targeted malware and ransomware attacks that hit Co-op and M&S, for example. And then there was supply chain incidents that hit Jaguar Land Rover and Amazon Web Services. And so this definitely still highlights the interconnectivity and aggregation potential that the cyber market has, hence why the importance of still developing new reinsurance solution for the space, and ultimately to help insurers provide capacity, not just to write to open market, but we still see a very healthy demand of brand new cyber MGAs coming to the market. And so without being able to create these new reinsurance solutions, insurers wouldn't be able to offer more capacity to new cyber MGAs. So what are the implications for the MGA sector post the recent 1/1? So as we've said here, navigating capacity placement and growth opportunities. So excess capacity often does need to be utilised. and this can enable MGAs to diversify your panels or lock in capacity on multi-year, longer-term deals. We're definitely seeing that coming up in conversations. I think also there's definitely a potential for MGAs to be able to obtain better economics and favourable placement terms. So certainly something that should be coming up when you're going through your own binder renewal discussions. Certainly where there's potentially more appetite from rated paper or being able to deal directly with insurers in kind of that non-niche specialized business, it's meant that actually brokers could gravitate towards removing MGAs from placements. And so ultimately then for MGAs, it is important to think about what are kind of like new areas or new lines of business that you could enter, which does require a little bit more specialism or kind of niche specialty underwriting that you could bring in to help you continue to grow in particular sectors. I think capital optimization strategies, and as David mentioned, you've already seen the start of this year with M&A activity. It's likely that MGAs could benefit from where the reinsurers have and insurers to some respects have almost a war chest of kind of capital that they need to either deploy, or if they're not deploying it, to acquire. And MGAs could definitely be targets and will be targets for M&A. And I think that's an opportunity either to crystallize your value or to actually raise growth equity, growth capital to go out and, as I said, either look at new lines of business, bring in new teams, invest into technology, etc. So, and at the same time, the interest rates are likely to further come down. More money is likely, to come out of potentially trusts or investments, and likely to mean that it's easier for companies to raise debt to go out after acquisitions. And then finally, I think, kind of linked to the last point, but everyone, especially kind of ILS or alternative capital, is looking to get closer to insurance risk. I think an example that you mentioned earlier, David mentioned earlier, which was interesting, is around Blackstone or BlackRock kind of coming into the Lloyd's market, setting up syndicates that tends to be focused on underwriting kind of delegated portfolios. I think there's a lot of capital that sees the attractiveness of diversified portfolios that MGAs write, and getting access to the yield or the returns of those portfolios when they're done on such large portfolios basis is very attractive to capital. So all in all, I'd say it's a very positive time for MGAs, and there's plenty of opportunity out there. And I think this is the final slide, is it? Yeah. Before we come on to Q&A. So really, it's I guess it's us just saying how GC has really been investing in the MGA sector over the last few years. As David mentioned, we have GC Access, or the unit that David and I are part of is kind of GC Specialty Access. We leverage broking expertise, analytics, and a global network to connect MGAs and carriers. As you can see here, around $7 billion of annual ceded premium means that, when it comes to benchmarking and utilizing that data to help you as an MGA make a decision about which line of business that you should enter or grow into, we can help you identify those opportunities. We have 55 globally connected brokers across various different regions. So if you're also looking to enter, if it was Europe or APAC, etc., we know the exact kind of broking contacts to help you enter those territories. We place over 250 MGAs and programs, and we have over 10 bespoke analytics and contract expertise. And on the right, as you can see, you know, when it comes to placing binding authorities, can range from residential and commercial property to E&O, transactional risk, cyber tech E&O, tax credits, trade credit, parametrics, motor, IP. You know, we have experience across the board on multiple different lines of business. So if there's anything there that you're in at the moment, or you'd like to enter and you'd like to have a discussion with us, we're happy to share these slides after the session, and we'd be more than happy to connect. So I think, Manveen, I think that's bang on kind of half an hour. So I thought, yeah, we can open it up to the floor for a Q&A.
Fantastic. Thank you. Well, perfect timing. I've just popped a note in the chat for anyone, if they do want to use the chat area to ask any questions. You have also got the option of raising your hand to ask questions. But just before and just to give some time for people to type questions or raise their hand, just to say thank you to David and Henry for a really insightful overview and insight into the reinsurance world. So thank you very much for that. Anyone have any questions they'd like to ask? We've just had one come through from Jack Morris, actually. How do we think that the excess capacity will impact 1/4?
I think it's more of the same, isn't it? I mean, in terms of, you know, the trends that we're seeing towards 1/4 is kind of similar to what we've seen at 1/1. Potentially, you know, there's opportunity to you know, carry on with the buyer's market, look to achieve you know, and obtain better terms. So I think it's more of the same at this stage.
Yeah, I would agree. It's much more of the same, and it was continuing to decrease the closer it got to key renewals, and some people, the later they went, the better they got. So wait and see approach to placement could well stand you in a better stead with regards to the level of rate reductions you could generate on your program renewal.
Yeah.
Fantastic, thank you. Jack, I don't know if you've got any follow-up or if that's answered your question in full. But any further questions from anybody at all? Just give it a minute in case someone is typing, but it doesn't look like we have any additional questions. So just going to check to see if anyone's popped anything else in any other area. Yes, there will be a recording of this. We will share this out via email to everyone that's registered. It will take us a few days to turn it round, but we will share a recording of the session. No problem. I'm going to assume, now that we've had a few minutes for questions to come through, that there are no further questions. So thank you to David and Henry for quite an oversight and insight into their world of work. Just a reminder, if you can spare a minute or two before the end of the day, just to share your feedback. Otherwise, thanks again to our amazing presenters, and thanks again to you as our members for joining today's session. And I hope you have a lovely rest of day.
Thank you very much.
Thanks all.
Fantastic. Thank you all.
Thanks, guys. Appreciate it.